Well, good evening, folks, and thank you for being with me this evening. It's good morning to our friends in Australia. Thank you, Mickey D. And good afternoon to our friends across the ditch in the land of the long white cloud. Well, so much to talk about. I mean, it's happening, and it's happening everywhere, isn't it? You've got real live cyclones hitting Florida. 13 dead so far. Terrible loss of property, devastation, life and property and everything else as well. Across the Atlantic, you've got financial carnage and devastation, particularly of pension providers in the UK with the new government. Liz Truss and her new Chancellor, Kwasi Kwarteng. The Chancellor is what the British call their treasurer, if you know what I mean about that. Then across the continent a bit further, you've got a real shooting war still going on, people getting killed, incredible damage going on in Ukraine. It's all horrible. But for you folks who are traders, it's all good news because it's given us a nice burst of volatility, and the trading has been pretty fantastic. Thank you, Monty. Good to have you with us. It's here. Most of our usual friends are here. We'd love to have you with us. Albert's with us. He's a tutorial guy. Gary's with us. George is with us. Graham across the ditch. How's your hand, mate? It's healing. And a broken hand. Very, very painful. Greg, who's a wealth fund manager in Colorado Springs and in Texas. And Greg Palladini, who's also a wealth manager in California. Grand to have you with us, guys. Hank down in the Hunter Valley. Harold up in Redding, California. Wonderful man, Harold. So good to have you with us, my friend. Jeff, of course, he's Jeff C is just about to do a tutorial, I think. Joe's with us, plenty of Joe's with us. Joel from Vero Beach is with us. Justin, that's Hank's son. Justin's with us down in the Hunter Valley, sometimes in Queensland. Not quite sure where you are, Justin. Mark's with us. He's a tutorial guy. Mickey D, of course, is with us. And we're going to be talking about something he's noticed. He's one of our very, very best traders. He's done 2 tutorials and is right on the ball with everything. The Murph is with us. I'm going to be talking to you next week, Murph, which will be grand. Monty, as I say, is there. Peter Mack, who's not a day trader. Grand to have you with us, Peter. Trevor, wonderful Danielcode supporter. And, of course, Vicky. Delighted to have you with us today, Vicky. Well, let's see what the world is holding for us today, because we've got a whole lot of stuff happening and much to talk about. If you noticed this week, our webinar was a week later than normal. I've changed it from doing it once a fortnight. A fortnight, as Greg's son knows, is 2 weeks. It's an expression I use a lot. It's a British expression, I suppose. But really a fortnight is short for 14 nights or 2 weeks. But it's not an expression that's used in the US, and it brings joy and laughter to some young people there when they find out, Greg was telling me. Anyway, we're now doing these webinars every 3 weeks. They take an awful lot of time. I know you do appreciate them so much, so we're going to continue to do them, of course, but just a little less frequently. So here we are. You know this stuff. Markets are rational, orderly, and sometimes predictable. And if you noticed, I named this webinar on Monday, Forex, gold and the US dollar, in the expectation that we were going to see some really serious Forex action this week, which we have, and it's been building up. It's been bubbling for a while, particularly with the yen, which is in all sorts of trouble. And then, of course, this week we've had a whole lot of excitement over in the financial markets of the UK and Europe. And as I say, Ukraine is still going on. It's still a front-of-face issue. Europe is still struggling with its energy wars with winter fast approaching, and the issues with their dependency on Russian energy supplies. But a big drama this week has been caused by the new government. Boris, as you know, is gone. Talk about a giant being felled by Lilliputians who just, I mean, for what? Having a drink with a couple of other parliamentarians in his private garden? That's the greatest sin in the world, I suppose. Depends how woke you are. Anyway, Boris was not woke, and nor am I. I think it's absolutely ridiculous. He's the best vote getter that Britain's seen in a generation at least, and they've just shuffled him off and replaced him with Liz Truss, who until she became Prime Minister was pretty much a non-entity. She's been a cabinet minister in Boris's government, and Boris was rooting for her, but she has come to power in a strange way that you may not appreciate, so we'll deal with that. And her new Chancellor is a very large gentleman called Kwasi Kwarteng. And he's a seriously clever guy. It's worth reading his bio. He's a very, very clever guy. You don't usually see people of that ilk in power. But anyway, the US dollar index has been setting itself up with a blue line and TO3 sell signals in the early part of this week. And as you can see what's happened, we're now getting a little retracement, which is fine. So, but that markets are so stressed at the moment, and so many of the other Forex pairs were so oversold on the pairs that are crossed with the US dollar that the reaction to the reversal has been pretty much a mini bombshell and wonderful, wonderful trading. So this is what we've been doing in Forex, folks. We don't talk about Forex as much as we should. So let me show you what you're missing out on. This is the Euro-Japanese yen pair. We had a TO3 buy signal for Monday, which was elected, and off it goes, making money. We also had a blue line and TO3 buy signal for Wednesday in the Euro USD pair, and it went whoosh, and a little bit more whoosh today. And just to refresh your memory, our blue line signals are the stronger signals that we create. We have TO3 signals, which are reversal signals. We have TO3 plus signals, which are the TO3 signals together with some continuation signals. And then we have our blue line signals, which are the most powerful signal we create. To get a blue line signal, we need target recognition, first and foremost. Then we need to be overbought or oversold on the fast stochastic. We need to be overbought or oversold on the slow stochastic. And we need divergence on our proprietary momentum indicator. And not all of the blue signals stick, but when they do, they're pretty potent. And you can see they've been charging along and showing off their virtue all this week. Plenty of money there. In this market, British pound, Japanese yen, this was a correlated TO3 buy signal. Don't forget the correlations. Very often, the correlated trades are financially better. There's Mickey D. The Russell Blue Line signal was deadly this week. Yeah, they are. When they bite, don't they? Anyway, don't forget the correlated signals, folks. This was a correlated TO3 buy. And I've mentioned before that sometimes the correlated signals are better or more worthwhile financially than the actual nominated signal in our TO3 plus categories. And that's because they're more subtle. They're a little less expected. They're a little less obvious. And that tends to get the market on the wrong side. When that happens, you get a nice big burst out of them, as we saw with the British pound, Japanese yen pair here today. So this is So this is the British pound against the dollar. This was a TO3 buy signal, and you can see it took hold, and didn't look very dramatic on the first day, but look at it today. It looks good, doesn't it? So that was another one for you. And of course, all of this drama that's been going on in Britain, which I'm going to tell you about if you're not already aware of it, was a huge surprise. You can see the size of these two bars. We had a TO3 buy signal, which was like whoosh, and it was right up past our blue line, and we got out, or I got out anyway, somewhere around that 92 area. It was a really fabulous trade. But being a big surprise, it's interesting. Surprises almost always, and I mean almost always, go with the Danielcode signals. We see this happening with the US Fed all the time. They'll come out with a decision on rates day that is against the market expectation, but it's with the Danielcode signals. These things are set up beforehand. Here was an absolute basic TO3 plus buy signal, which took off, and it's regrouping a bit now, trying to find where it should be, but it was a big trade. So that was it. So let's talk about the issues in the markets here. We've got gold trading near must-hold levels. This is how I viewed things on Monday. We had the US dollar on a monthly, multi-month tear, had to spark a reaction at some time. And unexpectedly, the spark was the US gilt market. So gilts are the equivalent, the British equivalent, if you like, of T-bonds, or T-notes. It's the way the British government funds itself, or more correctly, the way the British Treasury and the Bank of England fund the government spending plans. And basically what happened is that the new Prime Minister, Liz Truss, who was elected by the Conservative Party members, she became Prime Minister of the UK very shortly before Her Majesty the Queen died. So everything pretty much went on hold for a little while. And just this week we've had Liz and in particular her new Chancellor, Kwasi Kwarteng is his name. As I say, very clever bloke. You should read his bio. It's certainly worth reading. They came out with what they've called a mini budget. It was a bit more than a mini budget. And they've gone and taken a page out of Reaganomics, essentially, that they've cut the top rate of tax. They've reduced taxation and expenditure in other areas. Not expenditure, I should say, other forms of taxation liabilities in other areas. And the amounts of money that they're promising to cap energy requirements for the coming winter for the population, massive amounts of money. I think that's sort of $64 billion for just to get them through winter. They've got some of the same energy problems that Europe has, but not as bad. They're very lucky that they have massive reserves of gas up in the North Sea, but it requires fracking to do it, and in keeping with those unelected voices that are constantly getting in the way of progress. The previous government made a decision not to allow fracking in the North Sea. So Liz and Kwasi have reversed that straight away. They're looking for as much fracking and as much energy independence as they can get. So Kwasi was a bit gung-ho with that stuff, and it set off a run on gilts, and we're going to talk more about that as we go through. But basically, the pension system in UK, the various providers of pensions have to demonstrate to the government on a mark-to-market basis that they're financial, that they've got sufficient assets to meet the promises they make with future pension benefits. And the most common way they do that is by investing in gilts, long-term gilts like Treasury same as a US T-bond sort of thing, just the British version. But when you've got a whole lot of long-term gilt investments, and you add to that a bit of leverage, because there's always some nice gentleman from Goldman Sachs, JP Morgan, and the British bank saying, you can do a bit better than this, guys. You can have a little bit of leverage. You can add a few derivatives onto your investment, and you're going to look very clever, and it's going to be good for your future career and good for your CV. And of course, like we have seen exactly as I talked about in our last webinar, where a Chinese nickel producer had a huge, massive, multi-million-dollar bet on the nickel market, which tipped up and broke the London Metal Exchange. And of course, as I said last time, that was not what I would call a futures trade. It was a straight-out bet on one side of the futures contract without stops. So that's exactly what's happened here. The same thing, these people get involved in leverage markets, either in public exchanges, more often in private exchanges, private dealings with banks and other providers, but they don't have a stop loss because they actually don't know anything about trading. And it sounds a silly thing to say, but the reality is that the banks and merchant banks that are offering these products, they don't know a whole lot about it either. And that's how these people keep getting into trouble. They haven't got into trouble because of the leverage. They've got into trouble because they didn't have stop losses. That simple. And as you'll see as we go on, when the interest rates after Kwasi released his mini budget, the interest rate on gilts went bananas, ballistic. And had that been allowed to last, the vast majority of pension funds in the United Kingdom would be broken. So the Bank of England had to step in and buy, as it said, whatever's required, massive amounts of gilts. In other words, this is a country that is in the same cycle as most of the Western world, that it's trying to tighten up. The largesse that the central banks have delivered, certainly over the past decade and more. And all of a sudden they've gone from QT, which is quantitative tightening, to QE, which is quantitative easing. Buying bonds, buying them on a whatever it takes basis, that's the very essence of QE. And a complete about turn and slap in the face for financial conservatives. And this is all about this new government that's come to power and to replace Boris. And elections are less than 2 years away, and Britain financially is in a mess. It's got mountains of debt. It's got energy problems facing it over the winter. And the retirement funding in the UK, as I've told you, is pretty much mark to market, unlike in the US. And this big run in gilts, the interest rate roaring in gilts, would have had a whole lot of people in serious trouble. They would be insolvent, basically. It's as simple as that. So the Bank of England had to jump in and do what they did. So it all started with Boris, or rather with Boris's leaving 10 Downing Street. And the procedure to replace him was not a general election. It was a private vote by members of the Conservative Party, not the parliamentary members, the members of the Conservative Party, of which there are something between 180 and 200,000. Not a big number. They are largely older and very conservative. They long for someone in the Margaret Thatcher mould. And Liz Truss, who's a bit of a chameleon, presented herself as such. And part of her pitch was lowering the top rate of tax, which really was anathema to the financial community generally. And this is the opposite of Robin Hood. This is robbing the poor to give to the rich, and it went over like a lead balloon And that's a serious bit of drama. It's not over yet. So these are our new players, folks. Great Britain's still a very, very significant economy. We can't ignore what's happening there. And there's the lovely Liz and Mr. Kwasi, who is a huge man. And as I said, very, very clever. It's worth reading his CV. It's really interesting. So this is all about what's happened. This is from Bloomberg. And basically, if you have a very large portfolio of very long-dated bonds, a 25% fall in their price is a serious issue. Second, if you've been playing around with derivatives to try to get a little more return out of the lump and mass of those bonds, you have a real problem. So you can read this for yourselves, and it's about these pension funds in particular, and they had collateral pledged, and they had a little bit of leverage on it as well, derivatives. The margin calls started, and they were a cascade. So the pension funds were madly selling gilts to meet these calls, pushing their price down further. And they also faced the need to sell other assets that were sufficiently liquid, and not all of them are. So this is a classic example of contagion of the kind that drove the Lehman moment in 2008. Numerous complex financial products collapsed almost simultaneously. Most people remember that. But the Bank of England, BOE is the Bank of England, faced the prospect of imminent widespread pension fund insolvencies. And that can't be tolerated. They had to step in, and step in they did. So here we are. This is more of the story on the Bank of England and the action they had to take. And when markets reacted so poorly, I guess that's putting it pretty mildly. But what they've had to do, of course, is add a new stimulus without being the last thing they want to do. They've been on a promise to start QT, or quantitative tightening, and they've postponed that for quite a while this QE works its way through. So here's the short story. From the Bank of England scheduled meeting last Thursday until the early hours of Wednesday morning, the price fell by more than 24%. That's what happens when interest rates go up on bonds. Interest rates go up, price goes down, and vice versa. And the BOE stepped in. They have had plans, as I say, to embark on quantitative tightening, but they've had to jump in and buy, and the price rallied by 24% from its low in a matter of hours. This is in a bond market. This is the British bond market. I mean, these are massive, massive, massive moves. And anyway, let's see what's been happening with the other markets. Nothing's immune. When the butterfly flaps its wings, it leads to thunderstorms. So this is Comex gold. Frank has been saying that it's in a very precarious position, and it's not evident to me that that's so at the moment. It's actually holding its expected Danielcode support there pretty strongly, and it's been interesting watching the playoff between silver and gold in particular. They're highly correlated, but they don't necessarily move the same way. Silver's been much more bullish. Gold feels like it really needs to make some new lows and empty out a bit before it's going to be able to mount a sustainable rally. But that's just my looking at charts. Don't take too much from that. All you have to do to be on the right side of the gold market is follow your Danielcode signals all the time. But I found this particularly interesting. And it's not something I've looked at before, which is strange because I've shown you this relationship often. But these are the 12, this is one of a look from our 12-day charts. Every one of these bars is 12 trading days. And the chart on the top is gold, and the chart on the bottom is the US dollar index. And you can see that this inverse relationship inverse correlation is just so strong. But look how it's fading away. The line on the gold chart is the last low, last important low, and gold hasn't got down there to test it yet. Yet if you cast your eyes at the bottom chart, the line on that chart is the same time period that I was talking to you about in the gold chart. This is the US dollar index, and that line marks that last major high, and dollars just walked straight past that. No problem, no issues. And I would have expected, because the dollar has been so incredibly strong, I would have expected more weakness in gold, and it hasn't shown up. And that is, in effect, strength in the gold market. So have a look at that on your own charts and keep those two in mind, folks. It's interesting to observe that. Here's the problems with the UK. Its spending problems have been a long, long time in the making. It's been debt, mounting debt. The line on this chart is $1 US. This market is rapidly approaching $1 US or parity with the US dollar, which would have been totally unimaginable to the last generation of Englishmen. It simply wouldn't have passed anyone's conscious thought that the British pound could be so weak. But there you are. That's the reality. It's heading for that parity with the US dollar. And it's not so far away, really, is it? So that's there. So let's have a look. That's Britain's spending problem. Have a look at the US's spending problem. Money is being spent by the Democrats in the US as if it literally grows on trees. The spending by this Democratic government has been absolutely extraordinary. I see today someone finally tapped them on their shoulder about their student loan forgiveness and said it's just a whole heap of money, guys. So they're pulling that back considerably today, but it's still a massive amount of money that they're committing. The more money that's spent by this government in the US, the more the US dollar loves it. Look at this, loving it. It's been held by the one standard deviation for, all the way back. It's broken it at times and come back. And it's been right down at -1 standard deviation in January last year. Look at it now. It's roaring. It's heading for that dotted line above it, which is 2 standard deviations from the mean. That's a pretty big move, and that's having an effect all over the world. So here's the euro British pound. Part of the Brexit pitch was that being free of the euro, and Britain never adopted the euro currency, but being free of all the many, many rules that the Europeans created to tie Britain to them, and which Britain at one stage happily accepted. The idea was Britain would be so much healthier being able to run its own race outside the European Union. And currencies are not only driven by fundamentals, they're also marked by sentiment. If Britain was doing considerably better than Europe, you would expect to have broken out of this range trading. Britain's been in a range. The Euro GBP has been in a range. Admittedly, it's a pretty large, healthy range, but it's still been tied in that range since early 2016, and it's still there. It was looking good and looking strong, but boy, the problems that the Eurozone's facing with its energy. I mean, Merkel just went hell for leather with Russia, shut down their own, most of the German nuclear reactors, and allowed the country to become so dependent on Russian oil and gas. She thought that she could control Russia in a commercial way, but as you've seen, no one controls the bear. Angry bears roar and do their thing. And now, of course, Europe's trying desperately to pull back from using so much Russian energy, and Russia's happily found other people who want to buy it, mainly the Chinese, who are having a ball. They're buying discounted Russian oil and gas and on selling it, having a party. But there we are, that's what the markets are telling you, and currencies are very, very clear in defining what they think about markets, and that correlation there is real. This, folks, is a huge problem that we haven't talked about much. This is the Japanese yen against the US dollar, and MMT, modern monetary theory. The Japanese were the first to embark on modern monetary theory, and it holds that in a country that has its own currency that is internationally acceptable and also has a large export business, then it doesn't matter how much debt you accumulate because it's only payable in your own currency. Japan was the first to go on with this, and what they're doing is they're holding the Japanese central bank is holding interest rates on Japanese bonds at the old levels. There's no attempt at QT, no attempt at raising interest rates, quite the opposite. The Japanese central bank is just buying the bonds to keep the interest rate down very, very low. And of course, the other effect of that is it weakens your currency. And this is the US dollar appreciating big time against the Japanese yen. That's the story that's worth keeping in mind, because it's going to have to explode. It can't go on forever. And it'll be interesting when it does. So I had a friend who was a great international banker dealing in money markets primarily. And his saying was, it's always on the cross rates, always on the cross rates. You want to know what any currency is doing, you've got to look at it on the cross rates. So this is, excuse me, the Aussie dollar paired with the yen. And you can see the Aussie dollar's been very strong since the end of 2019. It's been on a nice uptrend. This is the Canadian dollar and the yen, and it's been doing even better. It started off this current rally in December 2019, and look at it, it's been pretty spectacular, hasn't it? Now compare it with this. This is the euro against the yen. It's been very muted, hasn't it? It's not taken out any old highs. It's got there and it's threatening them, but it hasn't gone on with the job. This is the British pound against the Japanese yen. Even worse. It's had a rally. They've all had that rally since late 2019. But this rally is nothing like we're seeing in some of these other markets. Interesting. Keep your eye on that. It's always in the cross rates. And today, here is the big story for you. UST bonds. Some time ago, at one of these webinars, I showed you this chart, which is back in late September this year. And I showed you that on the daily chart in the December contract, we'd had a daily close below the famous Danielcode black line. And the Danielcode black line is different from the other support levels, which all work on highs and lows. The black line itself works on support and resistance at highs and lows, but it has the added function that if you get a close below that line or above the line if it's rallying, it implies with a very high degree of probability in the 90+% area that the swing will be taken out. And when you look at these charts on a daily basis, it doesn't look like that's a terribly important move, because the swing low back in late June, early July this year is not very far away from the black line, but it's still important. Have a look at this chart and make a note. It's got 1 day up as the last bar you can see on it when I gave it to you. Now, this looks like a nightmare to you. It shouldn't. It's got that way simply because it's been working for years and years and years. I started showing other people this chart way back in 2000, 2002, and since then I've been updating it and showing it to you on a regular basis. Now, refresh your memories, the thick red line going through at an angle, that's the median or the mean of the Danielcode trading channel, which has been holding this whole market at 2 standard deviations above the mean and 2 standard deviations below the mean. And it's been doing that consistently since, I think it's, looks to me to be about July, earlier than that, might be, these are a 24-day chart. Each one of these bars is 24 days. We stopped moving that median line back in about June 2016. And we haven't moved it since then. Since then, it's simply been the extensions of that Danielcode trading channel, which you can see that it clipped the highs absolutely perfectly, and it's been in a pull down and a pullback since then pretty dramatically. You'll remember that that high back there, it's marked as March 30th, 2020, was almost perfectly at 2 standard deviations above the mean. This is an angular chart. In other words, we're looking at this chart on the angle, and all angles have qualities of both time and price. So you can see that the 2 standard deviations above the mean have been holding the high of this chart all the way through. We then started to move down, and some of you will remember that I said this has got to get to the 2 standard deviations below the mean at least, and if that fails it'll go to 3 standard deviations below the mean, and we put a price on the chart back then, which was probably June 21. And you can see it went down and it hovered around. It fought for 1, 2, 3, for about 6 months. It fought for about 6 months to try and hold that level 2 standard deviations below the mean. Now, these are not your normal mathematical standard deviations. These are Danielcode standard deviations based off our time cycles. So it fought hard to hold that, and I remember me telling you, if that breaks, the next support is down at 1, 2, 3, 4 standard deviations from the mean, and I gave you a eyeball estimate of where it was going with that little red line that says 125, correct 10. That was just an eyeball estimate, but it wasn't bad. And what you can't see with all of the other activity that's going on here is that this low that's just come in happened exactly on a Danielcode time cycle. I'll just put that back so you can see it. You can see there's the 62. You can see at the bottom running along there near where our current prices are. There's 44, 59, 62, 70. The 62 line is right on top of this current move down, which is why you can't see it on that chart. So I've taken the 62 off. And as you can see, exactly as I told you, the next support is going to be 4 standard deviations from the mean. And we've talked about this continuously since 2008. And it's really interesting that, you know, for just a wild eyeball estimate of what price would be when that time target was reached, it's not that far out, is it? And that's exactly what's been happening. Wonderful stuff. And bonds for you guys, wealth fund managers, you're very interested in bonds. My simple advice is sack your advisors. You're all subscribed to the Danielcode. We do a better job than whoever's advising you. Stay close to the market. Always is the best advice. So let's see what that meant in terms. So this was September the 12th. which is a couple of weeks ago. This was when we had a tutorial. I showed you this chart. This is the December chart, and I showed it to you with the targets underneath it. It was back at about 132.26 on that day, and the comment I gave with that chart was probabilities are it goes lower. And of course, with the black line, those probabilities are exactly right. Look where it got down to, 124. 0, or in fact 123.31, one tick off, one tick off the next level. Which would be the 32 ticks in this market. 32 ticks make a point. So this is the daily chart, which has been posted in members charts for a while, and we've got our TO3 and blue line buy signal. Which triggered off. But look where the low came. The low yesterday, Wednesday's low, 123 correct 30. So 2 ticks variance. The blue line was at 123 correct 28. How amazing is that in a volatile market? Perfectly perfect, isn't it? Absolutely wonderful. And what happens from here? Well, what I've said to you, we'll just go back for a moment. What I've said to you is basically what T-bonds is doing is what the government's trying to do. This is caused by QT, or quantitative tightening, such as it is, which is honestly terribly, terribly mild. But that's what it is. So this chart, the bonds chart, is what the government wants, basically. If it's going down, that's the government tightening up and interest rates increasing. The other chart against that is equities, which I've shown you before, the S&P, in regard to the movements in T-bonds, long-term government interest rates. The correlation's been huge. So if you're trading equities, make sure you know what bonds are doing, because they don't work. They don't work in isolation. One affects the other. Although usually there's no direct correlation between T-bonds and equities. I've seen, equities up and bonds down's the idea, but I've seen equities up and bonds up and both of them down. Any combination you like, as often as could possibly be. But right now there's a pattern, and that pattern is that T-bonds going down, interest rates going up. That's suppressing the interest in equities. And look what happened today. We had a lovely rally yesterday, a great big rally. What happened today? It's all gone away, hasn't it? This market is in a very, very delicate position, and very much at cross purposes. The impression I constantly get is that there's no violence to the downside. I keep saying to you, there's been no violence in these equity markets since the high. There have been a few days, but nothing that you'd really say that's violence. And I don't think this market can bottom until there's been some violence. So I think there's more to go. This has been, if this is all there is as a correction, then it's the weakest correction you could possibly think of. And I'm talking about the S&P and the Russell, and even more so on the Dow. It's been very, very strong, very strong. And all the doom and gloom hasn't really hit these markets. This is an interesting chart to have a look at. This is the S&P and the US dollar index. And you can see the inverse correlation here is massive. We usually look at this inverse correlation between gold and the US dollar, but this is the S&P in the top frame and the US dollar in the bottom frame. And I was just struck by the correlation back in 2008, 2009. And I was only looking at that period of time because Mickey D, Mr. Michael D, who's a great client of ours, he's really strong Danielcode guy. He's done 2 Danielcode tutorials. He's a personal friend. I've known his family for, I suppose, getting close to 28, 29, 30 years now, Mickey. But Mick is really switched on with his trading. He lives in Queensland, not that far away from me, and we should be having lunch more often than we do. But he brought to mind, he said, have a look at this, John. He said, the S&P, have a look what it was doing in 2008 compared to what it's doing now. So this chart, I couldn't get the 2 charts of different time periods to stack up into that particular tool I used to split the screen. But this is the S&P from the highs. This is the momentum high in 2007, October the 16th. Remember, this is a 6-day chart we're looking at. Each of these bars is 6 trading days. And it's had one move down, a little rally, another move down, another longer rally, third leg down. Don't think I'm counting Elliott wave stuff. I'm not. I have no truck for that at all. But you can see there's, however you count them, that's the problem, isn't it? There's market has generally gone down into the 33 period with 2 quite distinct rallies in it. So 33 Danielcode 6-day cycles, and so that's 180 plus days. Look what that pattern is: 2 little rallies into a low from the momentum high. Have the next chart. This is the current market. This is the S&P E-mini now. It's gone from the momentum high into a low this week, and it's had 2 noticeable rallies beforehand. It certainly had a much stronger rally, the last one, which I wasn't counting, coming down from the high. So, but there it is, 33 cycle, right on a low, high to low, 33. Previous one, high to low, 33. So thanks for that, Mick. Very interesting. And I know you do a massive amount of work on your Danielcode analysis and your charts, and we really appreciate it. And that was good of you to draw that to my attention, which I appreciate. So the yen, I'm not going to blast you about it, other than to say it's something you should be aware of, because the Bank of Japan intervened in currency markets for the first time in almost a quarter of a century, hoping to stop the slide in the value of the yen. And they may have to do that again. So forces that have seen the yen plummet to its weakest levels against the US dollar since 1998, however, are, if anything, intensifying, and therefore the intervention is a palliative, excuse me, and not a cure, according to the financial editor of the Sydney Morning Herald. There's been quite a lot of comment about that in Bloomberg and the Wall Street Journal. It's gone off the boil at the moment, but it's still there. Nothing's cured. Nothing's got better. It's a problem. So finally, I want to show you the micro targets in the S&P index. I've touched on this in our last webinar and showed you some of these, and it often brings cries, oh, too many lines, too many numbers, but in fact, there's not. But it's interesting on this these micro targets. They work exactly the same as our red and black lines. They're just a little bit more refined. And I haven't been putting these on members' charts because it can start to make the chart look very busy. And I know folks don't like that. But have a look at this, how perfectly this whole pull down from mid-August has gone. Down to its number at 41.21, down to its next number there at 3,886, little rally, 1, 2, 3, 4 days up. Next support, 36.26, perfect, all the way down, 26.51, gave you the close of that bulk of lows there, and the little breakout low that stuck its head down, 36.20 to the next level. And these micro targets are quite incredible, and we're working towards releasing micro targets probably on S&P, maybe the Dow, maybe the NASDAQ if enough people are interested in it, and T-bonds. All markets react to these micro numbers. It's just a question of whether we've got enough members to appreciate seeing more detailed analysis of those major markets. I guess we've got to include gold in there as well. All markets are bound by the Danielcode. If you don't get target recognition, you won't get a turn. That's a pretty straightforward statement. And if you don't believe me, and I don't expect you to, I expect you to do the research for yourself, go and have a look at our chart archives at the Danielcode website, where there are over 49,000 charts that I've created under members charts since late 2008, and you'll be hard-pressed to find a market that's turned anywhere except at its Danielcode target recognition. So I think that's about it for today, folks. There's more and more exciting stuff happening. If you haven't yet thought about running a Danielcode tutorial, make yourself an elite trader. Now's the time to think about it. Send me an email, jneedham@thedanielcode.com, and I'll be happy to send you some material. Or you can just go to the Danielcode website, where we have a new tab that's called Danielcode Learn to Trade. So there's a whole lot of difference between being able to trade and trading the Danielcode. They're entirely different disciplines. And once you know how to trade the Danielcode, it's your gift for life. You'll be financially independent. You'll enjoy doing the work, and it's not onerous because I've done it all for you. And the programs we give you with the Danielcode tutorial just set out exactly how markets work all of the time. And remember, the business of trading is making money. I talked to you about target recognition as vital to get turns. I talked to you about target recognition as vital in progressing as markets try to talk to you. That is so, but that's the mechanics. The real business and the purpose of all of those information blasts are that trading is the business of making money. So we're never going to release that. So we apparently are having some audio problems. We lost some audio for a while. It's back now. If you had a loss of audio, folks, this will be the video of this will be posted by Terry tomorrow, and you can pick up anything you missed with that suspect internet connection. If you haven't already, folks, please take advantage of our free trials. Simply go to the website, www.thedanielcode.com. Just hit the register button and follow the prompts. If you have any issues at all, please contact Terry at support@thedanielcode.com. If you have previously had a free trial some time ago, the website will remember that and won't want to give you another one. But if you let Terry know, he'll be happy to switch on your free trial. And that's something that you should be doing. Okay, this is our disclaimer. I do ask you to be cognizant that trading futures and derivatives, Forex, is a risky business. It is very, very easy to lose your money if you don't know what you're doing. And as you can see with the drama we have with the London Metal Exchange being blown up, the dramas with gilts this week, there are a whole lot of people trading that don't know how to trade, I can promise you. So don't you be one of those. Learn to trade properly before you risk any money. Trading is dangerous, and you need to make sure you know what you're doing before you risk any money. So that's pretty much me for today, folks. Thank you so much for being with us today. Here's Murph, yep. You enjoy your Bloody Mary. I'm ready to go. Monty said the sound was all right. That's grand. I hope it was. I got a notification saying that sound had dropped out for a short period. But there. So Harold says he always enjoy your insightful webinars when I can attend. Grand having you, Harold, of course. and I'm most grateful to you for all your hospitality when we were in Reading so long ago, wasn't it? Should do it again. Hank enjoyed that. Not getting too wet. We're not getting any rain up here, Hank. It hasn't rained for a couple of days. Not that we need any. Let me be clear. Not that we need any. And from Mickey D, the Russell blue line signal was deadly this week. Wonderful stuff. Thank you for being with us, folks. I appreciate it. I look forward to our webinars. And if you can post this webinar somewhere else with your friends so we can get a bit more interest in it, that would be a good move as well. So tell your friends and we can educate them as well. All the best for now and enjoy your weekend. Any questions, any markets you particularly want me to look at, please send me an email, jneedham@thedanielcode.com, and I will be happy to do that for you. But for now, it's bye-bye, and it's Friday morning down under at 11:30. The sun is shining, the pool is brilliant, and I think it's just about warm enough for me to take to the swimming pool any day now. And you folks enjoy your weekend and be safe. And to all you people down south getting hammered by this cyclone, our thoughts are with you. All the best for now, folks. Bye-bye.